everybody, and welcome back. Today with me there's John Vail. John is a Chief Global Strategist at Nikko Asset Management. Welcome, John.
Thank you, Thomas.
John, we've seen a lot of movements and volatility in financial markets during the last couple of weeks. A sharp slump in March and a significant recovery since that. So is the worst of the crisis already over for financial markets?
Yes, it does look like we've hit the bottom of markets globally, barring a major problem with politics or geopolitics, or of course a massive increase in OECD hospitalizations or deaths related to the virus. For now, it seems that the virus is getting better under control and that we have better attempts to and cures for it. Nothing is a silver bullet yet for the vaccine, but just today there was very big news about something that will help alleviate seriously ill patients. And by the time that the weather gets cold again, people will be much more careful this time than before in terms of social distancing and other factors. Of course, it's not going to be a perfect road ahead. There'll be some potholes. Right now, we're looking at second quarter earnings warning season. And a lot of companies have given no guidance globally as to what's going to happen with their earnings. And there probably will be more negatives than positives. And not only will that affect the second quarter, probably have some calendar year guidance as well that would be negative for the market. And it might even extend into 2021 consensus earnings expectations by analysts. So definitely have to keep an eye on this second quarter earnings warning season, and then of course the actual announcements in July and August.
So the effects of the pandemic on global economy will be felt for a very long time. To what extent are our current stock prices fundamentally justified?
Well, they're justified. They're obviously very expensive by historical standards, especially on this year's earnings. But even on next year's earnings, the market is close to, the S&P is close to 20 times next year's earnings. That's assuming that earnings are not downgraded at all. So that's very high. However, interest rates do seem to be pegged at a very low rate for quite some time, and it seems clear that the central banks are going to try to pin down not only short-term rates, but long-term rates as well. So stocks are going to be attractive from a dividend yield perspective. It's certainly possible that the market could be disappointed if there's some significant issues ahead, whether it's on the China relations with the West, or whether it's maybe some massive political change in the US. There are certainly risk factors out there. The market has not really discounted anything negative going forward. So we assume that the economy is going to be rather tepid in terms of growth in the next couple of years. Obviously, in the second half, we'll see a pretty big rebound, but we're not looking for major economic growth ahead. And so stocks have certainly priced in a decent economic recovery, and there are risks to that.
So the Chinese economy is currently in the spotlight. How quickly can China return to pre-crisis levels, especially given the West still struggling with the pandemic?
Well, certainly China is recovering early because it came out of its lockdown early. However, it's got its factories ready, but there's just not a lot of demand for a lot of their goods right now. I mean, exports have held up fairly well because of medical exports, but once those tail off as they're being produced around the world, exports could have a rough go in China. The domestic economy is reasonably strong. Housing prices have been increasing again after dipping quite a bit in the first quarter, and housing purchases seem to be quite strong. So infrastructure and residential construction demand seems quite high. That's being reflected in terms of steel and iron ore prices. Consumption is slowly rebounding. It's not a V-shaped recovery really in China. Consensus expectations for the Chinese economy is that it will regain its pre-pandemic level in the third quarter, but that might be a bit optimistic, and it's very possible that it could take longer for China to get back to where it started.
So we closely watched Hong Kong during the last couple of months. What consequences will the new security law and the US response have for the future and the meaning of the financial center Hong Kong?
Well, we don't really know the US response yet. They've made some initial indications, but they haven't really decided what to do. My inclination is to believe that the U.S. will not do anything draconian to damage Hong Kong. It probably will open its doors to a large degree to Hong Kong citizens. It seems to be a fairly consensus view to a large degree in the States that they will increase immigration from Hong Kong. As will most of the British Commonwealth countries. So anybody who wants to leave seems like they might be able to. That will include a lot of talented professionals. And Hong Kong will not be quite the same place as it was before, but it will always be important as a gateway to China. China is going to continue to be important, and so therefore Hong Kong will be important too. But it will be very interesting to watch what happens there in the coming quarters as people adjust to this new reality.
We've noticed the recent action of the US against Huawei. So is this some kind of proxy fight for a new global technology dominance between the US and China?
Yes, there's been a tech war for quite some time, and it's not just Huawei, but it's many other companies and technologies that the US wants to make sure it does not fall behind in and let China take global dominance, or to see China used in ways that are not acceptable to US values and European values. So there's many different levels of conflict, well beyond just normal exports and imports, and well beyond human rights issues and tech issues. So obviously, like I said before, there's also political issues like with Taiwan and Hong Kong that are being faced every day, and they're all sort of interrelated. It does seem like the U.S. Has made some major progress in convincing other countries to delay the use of Huawei in the core infrastructure of their 5G systems, rightly or wrongly. It's seems like Huawei is definitely losing market share, and the actual trade restrictions that the U.S. has put on Huawei is going to make it difficult for Huawei to supply a lot of global demand, and so it'll probably concentrate on supplying the base stations and infrastructure for China.
So there are presidential elections in the US in November. How will this influence the ongoing of the trade conflict between the US and China?
I think it's fairly safe to say, unlike what China is saying, to be honest, that the Democrats will be less tough on China. I could be wrong, and that they might. I believe that they feel quite strongly about the 5G issue and about human rights issues. But in terms of fixing the trade deficit, they didn't seem to have much impetus to do that before, and or to threaten in the way that Trump likes to do. And so I think a Democratic control of the presidency would be mollifying for trade tensions with China. That's my general opinion.
So this was John Vail, Chief Global Strategist at Nikko Asset Management. Thank you very much, John, for being with us here today and sharing your views with us.
Thank you, Thomas.